Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the performance of fixed income and equities and currencies across the globe over the past 1, 3, 6, and 12 months. We'll also have a look at the divergence between the broad commodity basket and energy prices and what that means for a country like South Africa. We'll have a look at the shock to precious metals on Friday. It looks to be continuing this morning, even if at a smaller scale. We'll also have a look at market expectations for the Fed funds rate, what's happening to US consumer confidence, the importance of Europe for SA trade, and an update on the tax numbers for South Africa. We're going to start off with performance. Last year, US equities gave a pretty good return, but even so materially underperformed what we saw across the rest of the globe. And this year has started off in much the same sort of pattern. If you look at Japan, Europe, emerging markets, they've all materially outperformed the US. Up to the end of Jan, US equities up about 0.7%. And if you look at futures this morning, and as of recording this, it looks like that 0.7% is about to be wiped out. So based on the current moves of the futures, we'll land up in a situation at the end of today where US equities are flat year to date, maybe slightly down, and the rest of the world up sort of 1 to 2%, depending on the country that you look at. So again, an environment where the US has underperformed, and that typically coincides with dollar weakness. And it is still the case that the dollar is not providing the sort of safe haven that one would want in risk-off trades. We saw that during the World Economic Forum. We're seeing it again now. The dollar isn't quite proving to be the safe haven that it was before, and as a result of that, we're seeing the rest of world equities outperform the US. Just on gold, even after the big sell-off that we saw on Friday, which saw gold down around about 8% or so, we're still seeing gold up quite materially year to date and up over 70% year on year. The other important point to note is while commodities in general have done pretty well, energy prices have been down year on year. And that's what we're going to touch on now. We have seen this broad-based outperformance of commodities, industrial commodities, relative to energy. And this has been going on since about September 2023. It's an environment which is clearly very helpful for resource companies, miners, but also very helpful for a range of commodity exporting emerging markets, clearly those that are not exporting oil. You'll end up with a sizable boost to your terms of trade. If you look at a country like Brazil or South Africa, your export prices go up a lot, your import prices come down. This is helpful for a broad range of emerging markets, and is one of the reasons why we continue to be overweight emerging markets, and we expect that EM currencies are likely to continue to fare well in an environment of dollar weakness. Now, onto the shock that we saw on Friday. It's quite remarkable. We saw silver down over 25% in the day. That's the biggest decline that we've seen in over 75 years. It wasn't just silver that was down. We saw gold was down just over 8%, or between 8 and 9%. Platinum was down close to 17%. So quite sizable moves across the precious metal space. Now, to put that into context, that only takes prices back to where they were in early Jan. We've seen a hang of a bull run in these commodities, and now we've seen a part reversal of that. Now, again, looking at prices this morning, it looks like we're going to see a continuation of the reversal. So maybe that takes prices back another couple of weeks. But it's important to recognize what's happened over the past year or so when looking at the sizable fall. And if you look at the rolling 6-month average, you look at the rolling 3-month average, those numbers are still going to be pretty good despite the fall on Friday. And that takes us to interest rates. Last week, the Fed kept rates flat as expected. President Trump was clearly unhappy with that. On Friday, he announced a new candidate to chair the Fed. It still has to go through Senate approval. And the market at this moment is expecting just 50 basis points worth of cuts from the Fed over the coming year. So it is an environment where things are quite tough for the Fed, despite the fact that energy prices have come down quite materially. Inflation in the US is proving to be sticky, and growth at the moment, by all accounts, appears to still be strong. So there's limited reason for the Fed to cut explicitly, aside from pressure, of course, coming from the White House. Whether that changes with a new head is yet to be seen, and it is only one member of the Fed that will change. And again, it still needs to be confirmed by the Senate, so it's all a bit early. We'll monitor this over time. But as things stand, we probably should not be penciling too much from the Fed over the coming year. And just one extra difficulty for the Fed to deal with, US consumer confidence continues to be weak. Again, it's difficult to reconcile these numbers with the very strong growth numbers that we're seeing come out of the US. The latest Atlanta Fed GDP Now estimate suggests that growth is running at over 4% in the US, but we're looking at consumer confidence that's looking at decade lows. So AI is playing a part, but it doesn't explain the whole story. It maybe doesn't even explain the majority of the story. Somehow we've got an environment where US economic activity is very strong while the labor market is looking pretty weak and consumer confidence is looking very weak. And I think that is going to be the key story over the coming year. It's how to reconcile the apparently strong growth numbers with the weak consumer numbers and what that's going to mean for the Fed. Finally, on to South Africa, we've got two charts to talk about. The first is on trade. We now have the 2025 trade numbers, so we can update our chart looking at the importance of a variety of regions and countries for the SA economy. Last year, South Africa exported 520 billion rands worth of goods to Europe. To put that into context, South Africa exported 220 billion worth of goods to China and 150 billion rands worth of goods to the US. Europe matters a lot for the SA economy, more so than China, more so than the US from an export perspective. And if we see signs of stimulus and improving growth and improving demand out of Europe, that is going to matter immensely for the South African economy. We need to keep close eyes on what's happening to the European growth situation over the coming year, particularly as it relates to SA through this channel. And finally, on the fiscal position, we saw an update of the tax numbers last week for the South African government revenue. Government revenue is looking to be about in line with the forecast from the medium-term budget policy statement, which was about 20 billion rand above the budget forecast from last year. So in total, the numbers that we expect to come out in February are going to be about 20 billion rand above the budget, and that does allow for scope for not having a VAT increase. The numbers may come out a bit better than that in the end because we have seen increasing revenue come through in February and March, and that may well be repeated this year. But from a conservative perspective, we're looking to see revenue again about in line with the medium-term budget policy statement, which means, I think, at best, no VAT increase and very limited scope for any form of tax relief. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.